You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. And now, it's time for the show that breaks down the options market from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts, Uncle Mike TOSAW from St. Charles Wealth Management, along with Mark the Greasy Meatball Sebastian and Andrew the Rock Lobster Giovinazzi from OptionPit.com. And now, get ready to hit the Option Block.
All right, everybody. That rockin' bit of tunage means it is time to rock out once again with everyone's favorite bi-weekly options show. Yes, time for the old OB, aka the Option Block. I will be your tour guide through this somewhat crazy tour through the world of options. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting, ever necessary these days Options Insider Radio Network, cranking out content for you guys to mainline while you're hanging out at home, freaking out and fretting over them there markets. Don't worry, we got you covered. Keep those questions, those comments coming. So many of you continue to ask about the markets being shut down, even though, I guess that's more realistic this week, but still, what happens to your options positions, even though we've touched on that many, many times. And yet still, the question comes en masse for me. I may have to reach out to the folks at OCC, and we just do one special explanatory episode about all that good stuff, so you guys can listen to that, and maybe that will put your concerns at ease. So we're cranking away for you. Glad you guys are listening, and hopefully you're enjoying and getting a little bit of sanity out of what we're sending your way. And joining me, I can't speak for the rest of these guys if they're going to bring sanity. I guess we'll have to find out. Let's start out. Let's go out to there's a lot of sanity out in the quiet, tranquil hamlet known as St. Charles, where we are joined once again by Uncle Mike TOSAW from St. Charles Wealth Advisors. Uncle Mike, hopefully you're holding up well, and B, hopefully you're getting some fine takeout from the folks at Skippy Zeros and Lemonade so you two can keep them open until all madness can resume, sir. He's too busy getting Skippy Zeros and Lemonade. Are you there now, Uncle Mike?
He's on the run.
You hear that tinny voice, listeners? That means we are also joined by the greasiest of meatballs, Mr. Mark Sebastian from OptionPit.com by way of Carmen Line Capital. Are you two enjoying, easy me to say, are you two enjoying some greasy meatballs and indeed some Skippy Zeros and Lemonade out there, sir?
Well, not Skippy Zeros and Lemonade, but I think there's some TBK, as we like to call it here in Riverside, coming, Taco Burrito King, on Taco Tuesday, and been enjoying some Capri and some Choo Choo restaurant, another Riverside staple. So, we've been doing our best and really enjoying and relaxing ourselves. And, it's 55 and sunny, so I think my boy's going to have gym class sometime this afternoon with getting schooled by his dad in some basketball and maybe some baseball, and we'll go from there.
There you go. We're going to go from there right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed the portion of the program where we break down what the heck is going on out there in their markets. And yeah, it's another weird one to kick off the week, listeners. In fact, as we speak, the market's firmly once again in the green. S&P threatening to be up 2.5%. The Dow up about 2%. Nasdaq up about 2.75%. So yes, we are rallying yet again. For those of you playing the home game, that's pretty much everyone out there right now. It's a bit of a weird one. I have to say, it was a little bit of a head scratcher for me. You know, we've heard, of course, at the end of last week, we saw terrible jobs numbers, much worse than the economists expected. They were expecting somewhere around 1.5 million. We saw 3.3 million. Instead, we see the death tolls, which no one wants to see, doubling almost every few days, which is not a trend anyone likes to see. We're seeing the government now talking about extending the social distancing and the outages and the closures all the way to April 30th, which a lot of sane heads knew was probably coming, but now it's official. There's even talk out there of completely shutting down the markets, which is absurd. I think we'll get to that in a little bit. All of that coming into this week, and we're rallying. We're up 2.5%. And coming into showtime, the VIX was at about a 60. That puts it up about 2 handles from where it was this time last show. Our old friend VVIX, the vol of vol, still frothy, still turbulent, down about 7 points from where it was last show, but still up at about 160, which still puts it as, I think the technical term is just absurdly elevated. VXX, our old friend as well, ticking back up to the 50 handle, up 3 points from where it was this time last show. But yeah, I'm having a hard time. Maybe you guys can explain it to me. I'm having a hard time in my head of heads here trying to figure out why the heck we're up on all this news. Maybe we'll start with Uncle Mike, because he's usually my bastion of optimism, my go-to guy for a ray of sunshine. Uncle Mike, first off, hopefully you can hear us now. Hopefully you got everything sorted out on your end. And B, if you can, sir, why the heck are we up on this day of days, sir? Tell you what, we're going to rephrase that question. I will instead turn around to my bastion of negativity and cynicism, the greasiest of meatballs. Mr. Meatball, why the heck are we rallying today, sir?
Because it's a Monday and we've got a quarterly rebalance, and I think that we're seeing a little bit of easing in volatility. That Abbott Labs news, I think, was really positive, and that they're doing some testing, so maybe there's some light at the end of the tunnel. I think you have to just kind of assume that's where everything comes from.
Look at you being the little ray of sunshine and optimism out there in the marketplace. The Abbott Labs news was, yeah, that was interesting. That's, of course, labs out in the burbs out here of Chicago with some quicker testing. Still, I don't know if quicker testing is the end all be all here. We know faster. That's good, of course. Knowing faster is better, but it's not exactly an end to the madness out there. Of course, if you want a nice ray of sunshine in your lives, listeners, I heartily recommend you avoid the Advisor's Option episode which hit the network this morning. Not a lot of rays of sunshine, unfortunately, to be had on that one. A little bit more dour, pessimistic outlook for the near future. But I'm going to be optimistic myself. I'm going to try yet again. Hopefully, the fifth time is the charm for one Uncle Mike. Uncle Mike, sir, can you finally hear us? And if so, why the heck is the market in an Uncle Mike type of mood today, sir?
I mean, what's that to like? No, I'm just kidding. Can you guys hear me okay?
Yeah, you're much better now. Go for it, sir.
Okay, very good, very good. So I'm a believer that the market knows things before the rest of the world does. The market's kind of magical that way. So the one argument would be that the market already knew that we were going to have the high jobless claims, we were going to have the death rates that we had. The market already knew it. And then a couple of weeks ago, before anything bad actually happened, the market just went down in such a tizzy as it did. But the concerning part about things right now is that we can't leave our houses, it looks like, for another month. So that's definitely a concerning thing with which we have. So with that being said, one of the harsh facts of life whenever things like this happens is it's typically bad for small businesses, and it can ultimately be good for big businesses. So, for example, Joe's Hamburger Joint is going to struggle through this because they don't have the cash reserves to weather the storm. And Joe's Hamburgers or Bill's Hot Dogs or whatever, the local fast food places are probably going to struggle pretty bad. And so at the end of this, you're going to have Joe's Hot Dogs or Joe's Hamburgers go belly up. However, there's places like that throughout the country. However, McDonald's is going to survive this, and ultimately, because McDonald's is going to take more business from Joe's Hot Dogs or Joe's Hamburgers, it's ultimately going to be good for McDonald's throughout this time. So from a market standpoint, I think ultimately we are going to recover better than we ever have before, just for that reason, because 80% of all U.S. business and commerce is in the S&P 500. And so those 500 companies are going to end up taking business from the small business. Now, the people that are going to suffer are the smaller business throughout this, the Skippy's Euros for that matter. So that's ultimately not going to be a good thing for them. But you will be happy to know that Skippy's Euros is open right now for takeout. So I know you're kind of worried about that, Mark. But I think that the market does know that, and they know that things like that are going to happen. Now, the companies that really changed the world throughout this market the last 5-10 years are the FANGs. You have Facebook, Apple, Amazon, Netflix, and Google. Those companies are going to be okay with this. People can still use Facebook just as easily as they always could. Amazon, I believe that's even a positive stock on the year. Apple, well, whereas Apple, they're probably not going to, they're probably the one that's probably could get hurt the most of the FANG stocks throughout all this. But Apple has $8 bajillion in cash. What the heck do they care? People are still going to watch Netflix, and people are still going to use Google. So those companies are the companies, and other companies that are kind of like them have really driven the market upward. And so during this time, those companies are going to be just fine. So I think that's one theory as to why it is. Now, the other thing that I would like to say with this is that we could be in for a double bottom. And so I know that's something that we're looking at. The Investor Policy Committee at RCM is looking at that right now because we've gotten pretty cash heavy in a lot of our stock portfolios for obvious reasons. And that could happen. So in the short term, this is anyone's ballgame. But in the long term, I like being in companies like the FANGs. I like being in situations like that because of the fact that ultimately big business isn't going away, folks. And for small business, it's going to be tough. But for big business, I actually think this is a huge buying opportunity. I'm not trying to be mean to the small business, but just kind of a harsh reality of the world with which we live.
Uncle Mike kicking the small businessman while he's down. Send your hate mail to Uncle Mike at stcharleswell.com. I'm just kidding, of course. But interesting stuff afoot. Mr. Meatball, aside from explaining the madness that is our rally today, what have your crazies in your vol trading club, what have they been up to? What's been catching your eye out there of late, sir?
Yeah, there is, when you look around at what's going on, there are some companies that are clearly going to lose and probably lose pretty quickly that you have to wonder, okay, what happens next? And as I'm looking at some of these names, I see some names that are pricing like, hey, this could be the end. There's a whole list of names that, the whole mall retailer, we have to ask ourselves about the efficacy of that business. I think a name that I've homed in on, and I know, Mark, this is going to break your heart and is going to make you feel extremely sad. I'm going to say GameStop.
Oh, GameStop, yes.
I think that, they're $3.80, and that may be $3.80 too many. I think they've got some real problems. Darden Restaurants, don't get me started. Macy's, are they going to go the way of the dodo now? They might. You got to wonder, is there going to be like, and JCPenney's already completely cooked. Any hope for them has to be completely gone at this point. But you look and you've got of like the nice retailers, you have that are publicly traded. You've got Macy's, you've got Dillard's, you've got JWN, Nordstrom, and, what other major, Gap stores? I mean, which of those survive beyond? I mean, I'm going to say JWN probably does fine. They've got a really good online presence as well. They invested heavily. But, where does Macy's go from here? Where does, JCPenney, where does Dillard's, and not to mention like the aforementioned GameStop. I mean, and here's how I know GameStop is dead. I literally was online teaching a woman, very nice lady, who is friends with my son, how to buy a game online on the Switch, and she said, why I don't ever have to go to the store again. And I said, no, you don't. And, for moms don't really want to go to moms and dads, although this dad does, and I know the dad I'm talking to does. A lot of dads and a lot of moms don't want to have to go to a GameStop. They want to they love the idea of going online and just buying whatever. And, which is not the same as like clothing. I think that you have to ask yourself, where does that go? And, I've been kind of eyeing like 1x2 trades and things like that in GameStop that I think it could absolutely go, bust. So I was noticing that you can do like the January 2022 3.5, 1.5 put 1x2 for like 75 cents. That doesn't seem like a bad trade to me.
GameStop, yeah, not exactly banner times for them. I mean, the specter has been looming for them for some time with digital distribution on most of the platforms, which is why they've shifted to tchotchkes and quote-unquote collectibles, as they like to say. We may have one or two floating around here in the studio as we speak. But you're right, trading shy of $4 right now, $3.81 off another 41 cents, or about almost 10% again today, bucking the trend of everyone's got a rally apparently today. Not GameStop. Not exactly looking good out there for them. But hey, maybe you disagree. Maybe you're a long GameStop, think this is the scoop of the century. They're going to turn it all around. Write in, let us know. I know second that ticker goes up on a place like a StockTwits or others, you guys are going to let us know. So we'll hear from you. The longs will be out, and the shorts will be as well. So we like hearing from both sides out there. Let's see what both sides are up to out there today. Coming into showtime, pretty light day overall from a volume perspective, which is probably not exactly surprising. It's kind of a mild rally, all things considered. If it's not plus or minus 4%, it seems like the market just doesn't want to get out of bed from a volume perspective, and that's pretty much what we're seeing today. VIX coming into showtime, not quite 250,000 contracts, about 240,000 contracts on the tape. The ADV is about 1.25 million, so well shy of that today. The SPY, at least before we get to the SPY, at about a little bit north of 3 million contracts right now. The ADV is closing in on 7 million contracts, 6.75 million contracts. It's a lot of paper, however you want to parse it. And again, we're in an entirely electronic environment, listeners, so SPY just putting it all up like crazy. SPX, similar numbers, decent paper out there, 750,000 contracts. ADV still north of 2 million, even though we're pretty much fully electronic out there on everything, including the 2.12 million out there right now. So spreads are wide, displayed size is a little light, yet the ADV still somehow managing to stay up there. The Qs at about 250,000 contracts as of a few minutes ago. The ADV a little bit north of 1 million, 1.02 million, and the Russell 2000 also closing in on 250,000 contracts as of a few minutes ago. The ADV 660,000 out there. Moving on out to the most active individual names out there. Top 10 only cost you 86,000 to break into the top 10 as of a few minutes ago. That gets you all the way to GE. Number 9, Netflix, a mere 89,000 on the tape today. Number 8, Disney. Looks like a lot of familiar names in the top 10 today. Disney, 99,000 to just threatening to break into triple digits. Then we got Facebook at 101,000. Number 6, AMD, 156,000 contracts on the tape. Number 5, good old Tesla at 164,000 contracts. Number 4, Boeing. These two neck and neck in our top 10 here. Boeing, $1.98 on the tape. Number 3, Bank of America, 204,000 contracts on the tape. Numero dos here, usually number 1. It's been unseated today. You got Apple down at 262,000 contracts. That means number 1 with a bullet Everyone's Skyping themselves to death out there. 275,000 contracts. So number one, yes, good old Microsoft. Been dominating the tape here for quite a while. Hasn't quite been top 10, usually a top 1, I should say. That's usually been Apple. Right now, at least, Microsoft wresting away the top spot out there. Unless you forget, there are still some earnings on the horizon, and looks like going to be a humdinger of an earnings season on the horizon. So already some reports getting put together for that. The tail end of the season here, worth noting there are still some interesting names popping off this week. If you want to stay micro, you want to stay fixated on individual events, can't really blame you. Got some decent names popping off this week. BlackBerry still coming out here on Tuesday. Conagra Brands out there. Thursday got CarMax and Chewy. Chewy.com for all you pets owners out there. And then good old Walgreens Boots Alliance. I just like saying that out loud. Sounds like a Star Trek name. The Walgreens Boots Alliance. Also popping off on Thursday. And then Friday, Constellation Brands. They may know and produce a beer you may be familiar with called Corona, which is perhaps a dubious name to be touting out there these days. A couple of reports here just to ease the madness. Let's go to Chewy first. They're popping off on the 2nd. And these are courtesy of our friends over there at ORATS. Of course, check out the full reports, theoptionsinsider.com. You want to learn more. At the time of this report, they were trading $36.16. They were pricing in about $2.18. That's pretty rich compared to previous earnings announcements. They priced in the past, or I should say they have delivered $1.40 in actual movements. So a little bit more robust. Again, I think you're going to see a lot of that this cycle as people are not sure what the hell companies are going to report. So they're going to be pricing in some juice. Walgreens Boots Alliance, let's see, they're trading exactly $44 going into this report. They were pricing in $1.70. That's actually a little bit of the opposite of what I said. In the past, they've moved nearly $2, $1.99, pricing in a little bit less. Walgreens has been doing well of late, one of the few bright spots in this bleak economy right now. And apparently they're pricing in a little bit less vol. That's also on the second. You can check out that and a lot more, theoptionsinsider.com. Meanwhile, let's keep on rolling. Let's get a little weird. Let's get a little wild. It is time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, welcome to the Odd Block, the portion of the show where we get a little weird, a little wild, see what's cooking out there on the unusual activity side of the option space. It's been a little while since we've unleashed our Eye of Sauron, see what it could find for us out there. So we're going to do that today, see what we've got cooking, actually finding some interesting stuff out here. Perhaps not the names you might expect. We're going to kick things off in good old Philip Morris International. Which is kind of interesting. Not a name we've talked about a lot here anymore. Not a brand name people like to think about. Folks have usually moved away to things like Altria and other fun, much less scary sounding names. Yet Philip Morris International still thriving out there and thriving today as well. Up, trading about almost $72, up about $2.75, up nearly 4% today. So outpacing the market to the upside here. This is the name that's had an interesting year. Year ago was trading a little bit north of here, about $88. And then it kind of hung out there for a while, and then looks like in August it sold off down to about 72. Then it kind of rallied again, got all the way up to its pretty much 52-week high in February, right around $90. And then, of course, we all know what happened in late February, early March. The bottom fell out of everything, including apparently Philip Morris International. You think this might have been actually maybe a little bit of boom times for them, folks, if ever they need a cigarette. Now might be the time. Of course, maybe a little hard to get those when every pretty much corner bodega and convenience store has been closed. But still, just from a pure demand perspective, you think the demand might be there. So they sold off pretty hard down to their 52-week low of $56.01. So they went from about nearly $90, actually about 90 exactly, 90.17, all the way down to $56.01 in the span of a week and change. So they took a bit of a drubbing, I think to say the technical term. And they've been enjoying this rally ever since. They've been back up, like I said, they're up to $72 now. So they've rallied quite a bit, 16 handles from their low. So a bit of a V-shaped recovery so far here, at least for Philip Morris International. Let's see what our Eye of Sauron picked up out here. Looks like someone, Mr. Meatball, is fading this rally. They're saying, yeah, you know what, this is good. I'll take it, and I'll take this rally, and I'll take all the delicious juice that it gives me to the upside, and I'm going to crush it to the tune of the May 80 calls. So still a wee bit out of the money, and not that far away from where they were trading a year ago, only $8 shy of that, and only $10 shy of their 52-week high, saying you're probably not getting back there again anytime soon, at least by May expiration, because they crushed 10,000 of the May 80 calls for $1.61. That's a penny off the bid, which kind of shows you gotta work it a bit. You gotta really kind of be aggressive with it, I should say, out here if you want to get 10,000 of anything off these days. The bid was $1.60. They got a penny better, so I guess they can't feel too bad. The market was over $1 wide, so you got to do what you got to do to get things done. This went up on the NOM, a.k.a. the NASDAQ options market. Worth noting, there are some earnings baked into this cycle. Earnings are on April 21st, so this guy's going to have to ride through some earnings. I guess he's not too concerned about that either, because he's saying $1.61, 10,000 times. Yes, I will take that. Mr. Meatball, what do you say here about our friend here to taking advantage of a little bit of an aggressive V-shaped recovery in Philip Morris International to crush the heck out of these calls, sir?
Yeah, it looks like kind of a covered right type of trade. My guess is that they're looking at the implied volatility in the options and looking at how far out of the money and saying, you know what, with where Philip Morris is, do I care if I sell this thing at $81.60 a share? Nope. All right, sold to you. And it is very much appears to be that kind of trade.
Can't really fault this guy if they're going to give him that, and especially in this environment, you could easily see that V turning into a W in the near future, in which case he thinks he probably can buy these back pretty cheap. Maybe you want to use some of that premium to buy a little bit of some hedge protection too. I'm just going out there and saying it, but hey, crazier things. This guy looking to put away $1.61, 10,000 times. Tell you what, we're going to come back to our friend here, see how he fares. I'm going to go out on a limb and say he probably keeps pretty much all of that money, or at least most of it. He might have a chance to take it back off sooner than he plans. But I'm going to say go out on a limb and say he keeps most of it. I'm going to say he keeps at least $1.30 of this $1.61. We shall see. We shall see. That's why we put it in the to be watched category, so we can come back. Maybe you think I'm mad. Maybe you think this thing's off to the races. Let us know. Let's head on out to our next name/victim. Kind of some interesting ones here today, which makes it kind of fun. Names you don't talk about too often, including the next one. This is just interesting on several levels. This is Lloyd's Banking Group, PLC, ticker symbol LYG, trading today a whopping $1.60. So if the Philip Morris up there threatening the $80 was too rich for your blood, got you covered to the downside here, $1.60. Some might say that stock is an option, but that's a conversation we've had many times in the past. We won't revisit that today. Instead, let's look at where this stock has been over the course of the past year. A year ago, it was trading pretty much 2x. It was around 328, and then it kind of slowly sold off to 233 in August. Then it rallied back up again, back to 360 almost. That was pretty much the high of the year in December. And that brief little blip was pretty much about it, because then it's pretty much been all downside ever since. Bottoming out recently at $1.33. That was, a week ago exactly. And now it's had a little bit of a V-shaped pop here for Lloyd's as well, even though it's coming off it a little bit today. It's off 4% today. So giving up some of that size upside it's had of late out there. Let's see what in this $1.60 name, let's see what the heck we had going on out here. What did our Eye of Sauron find? Looks like it found, I guess you can call these line in the sand puts, but at this point they're also pretty much buying the stock puts, because that's what you got. It's the October 2 puts, $2. Yes, so pretty deep in the money puts at this point, listeners. Going up 5,095 times for 55 cents right off the bid, crushing the bid. These are pretty tight, actually. These are only a nickel wide, which is surprising for a fairly inactive name. There must have been something lurking in that book, and they crushed it to the tune of 5,095. But someone clearly stood up to that bid because they wanted more, and they got more. A total of 22,000 of these bad boys have gone up on the day today. So someone, Mr. Meatball, drawing an aggressive line in the sand, saying, if this stock gets back around $1.45, I will take it. I will take it all, and I will take 22,000 of these puts for around 55 cents. Mr. Meatball, what say you here to what looks like a pretty aggressive and also in the money line in the sand. Don't see too many of those, Mr. Meatball.
No, you don't. But it's definitely a unique one. Somebody looking to probably take delivery and taking a little premium at the same time. It's like you said, it's a de facto stock. But with how high vols are everywhere, I get why everybody's doing that. I think that, now is the time to really spend some time looking at, Buffett type investments. I don't know that Lloyd's Banking Group is a Buffett type of investment, but selling as long dated put as possible is as Buffett-y a trade as you could possibly come up with.
I'm glad you brought that up because I was just going to ask you. You've been kind of wading into these Buffett put waters for a little bit now. I'm curious, in all of your Buffett put selling, has it ever occurred to you, or would you even think of using a pretty deep in the money put? And that's putting a different wrinkle on that Buffett trade, sir.
Yeah, that is essentially you're doing a covered call all at once. Most of the stocks that I'm messing with are stocks that have a dividend, and so I don't really want to deal with a lot of the carrying costs, and I don't want to exercise them. So, like, if you, without getting too deep into the basics of options, if you're carrying a short deep in the money put, and there is a decent sized dividend, then right after the dividend gets assigned, right after the dividend gets paid, your chances of assignment can become pretty high. So I get what the customer is doing. This does have a dividend, but I think that for me, I'm more of an at the money, out of the money put seller, especially with how high vol is. So just to put things in perspective, the ultimate Buffett trade would be a long-dated put in Berkshire Hathaway. I would say that's a Buffett trade on a Buffett company.
Buffett on Buffett.
It's little Warren Buffett had a Class B share, buying its companies in privately held subsidiaries.
Now, if you listen to Jimmy Buffett while you did that trade, you could have a Buffett on a Buffett on a Buffett. What do you say to that?
I know. So, one trade that I really like, and I advised, I suggested it to a couple different people, is the June 2022. So that has 1,200 days to expire? Something like that. So the June 2022 160 put, you're going to collect over $20. That's an annual yield of over 8%. That's not bad. And with how high vol is, it's 32% vol, 31% volatility. They were 16% before this all began. So I may be buying this thing back for $6 in a couple of weeks. Not a couple of weeks, a couple of months if vol comes in and the stock rallies. So this is a really nice approach that I'm trying to use to get some stocks that I really like. And, the lone risk that you have with putting on a Buffett and a Buffett trade in a Buffett company is a Buffett joining the company of the heavens.
And I'm glad you pointed out taking it off, because people are going to, once they hear this, are going to instantly push back at you and say, well, I don't want to tie up my capital until June of 2022. It's not your plan to hold these all the way to June 2022. You're probably planning on taking these off. Maybe not a few weeks, but like I said, maybe a few months, certainly less than June 2022. So I wanted to just put that out there, because that's obviously the pushback. I got to tie up my capital all the way to June. I don't want to do that. So probably have an opportunity to take these off. That's your plan as well, Mr. Meatball?
Yeah, I mean, so the thing about this is I mentioned that the volatility has doubled, and there is just a massive amount of vega, which is how a option moves as implied volatility goes up and down. So these options have almost $1 of vega. So that means so they have an option of vega. They have $1 of vega, and they are a 30 delta call or a 30 delta put. So Berkshire goes back to 200, that would be a rally of $15. That means these things would lose, give or take $4. So that puts them at $17. And then they have $1 of Vega. Obviously, the Vega is going to drop as the premium sucks out of it. But if volatility drops back to, let's say, 18, then you're talking about 13 bucks, 13 points of implied volatility. And let's say that you're talking about 75 cents of Vega per contract over that fall. You're picking up another $10. So with a rally to 200 and a normalization of volatility, this $21 option will be worth about $6. And if I don't close that, I am a jerk.
I would say you're technically a jerk at that point, yes.
I'm a jerk anyway, but this makes it official.
I wasn't going to say that, but yes. Some may put that out there. I'm just kidding, of course. We got some other activity here we reviewed from stuff from back in early March. We'll get to that. I think we'll save that for another show. Spoiler alert, a lot of people got run over selling some puts and indeed buying some calls. Neither of those worked out. We'll get to those next show, though, because Uncle Mike's champing at the bit. He wants to get at you with a little bit of the old strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, listeners, it's Monday. That means it's time for Uncle Mike to come on down from on high to dispense some options, wit, and or wisdom, and or perhaps sanity, which we all could use in these troubled times, provided, of course, that the lines remain open between here and St. Charles. So, Uncle Mike, as long as the old Ma Bell lines smile upon us, sir, what do you have in store for us today?
Well, I want to go through an opportunity that I did with a client today, actually. And so there's going to be, like I've said before on this show, there's three styles of management with which I do. One of them is aggressive trading. One of them is more of hedged investing, and one of them is buy and hold. And I want to talk to the buy and hold community today a little bit on something you can look to do. So a client was actually in a specific ETF that tracks technology. And so the ETF was actually at a loss because, well, markets have come down a bit. And so with that, what we were able to do is we sold the ETF for a loss because this client's a very high net worth individual. And we got back into some individual stocks that actually were tracking the ETF. Not all of them, but just enough to where we felt that it was a pretty good trade out. It wasn't like a major trade, but just the concept of this is something that I think you need to look into. What I want to start off by saying is that there is something called a wash sale, and you need to avoid that. So in other words, let's say that you own SPY, the spider ETF that I talk about all the time, and it's at a loss right now, let's say, from where you got into it. If you sell it and then buy it again within 30 days, then that loss will not count towards your taxes. So in other words, and let's say that you sell it in your individual account, then you buy it again in your Roth IRA account or your regular IRA account or whatever, it won't count. Now, the other thing with which you need to have an understanding of is that let's say that you sell SPY and you buy IVV, which is another ETF that tracks the S&P 500. Same thing. It's going to be whether you get audited or not. I mean, I'm not the IRS. I don't claim to be a tax expert, but it will raise a red flag. And so it's not something with which you want to do.
Mike, what about something like how close does it have to be? Because I have a question about this. Can you sell SPY and buy like the diamonds, or just for the customers? Because I'm sure they're asking these type of questions.
Well, and that's where it's a gray area. Like a lot of things with the IRS, that is a gray area. So if it's a similarly tracking index, I think I personally wouldn't feel comfortable with it doing that. But what I would feel comfortable doing is two things. One thing, if you want to sit it out for 30 days and think, okay, this market's not either going to go down or go nowhere for 30 days, then you can buy the same thing after 30 days and you're fine. That's one thing. But if you want to get some exposure right away, here's something that you can do that could be of interest. So let's say that you believe that, and I'm just going to make up, we'll use XYZ stocks. Let's say you want to sell SPY because you want to take the loss on it, but you've done your research and you've looked and you believe that XYZ stock, these 5 stocks or these 10 stocks or whatever, track the S&P 500 almost identical, let's say. What you could do is you could buy those individual names. Now, here's what that does. The concept is that, number one, you're able to harvest a loss. And harvesting losses is a good thing come tax time. This client that I had, or that I have, I shouldn't say had, but I have, that we discussed this morning, like I said, he's a high net worth individual, and we have some stocks that we believe track the specific ETF that he got out of. And so what we did was we bought the individual stocks. We bought just a few of the stocks. And what this kind of does is it's a way with which you can upgrade your portfolio to something that you believe is what's best in breed. So if you believe that, let's say that JP Morgan is a great financial stock, you like JP Morgan, Goldman Sachs, and whatever other stocks you want to use in it. As you can tell, I'm just making these up as I go because I can't really give real names for what I do for compliance reasons. But let's say that you really think those stocks are the best financial stocks and you want to take a loss on XLF. That's something to consider because of the fact that what you're doing then is all the other stocks that are in XLF. Now, by the way, I'm holding on to XLF because I think the financials are going to be really good in the next 5-10 years. But let's say that you believe that those stocks are the best in breed within XLF, then what you're doing is that you're selling all the stocks that you believe are bad, buying the ones that you're good, and you're getting paid to do it by the federal government through being able to harvest a tax loss. So what I would recommend doing at this point in time is, this is for money outside of an IRA, of course. IRA money, this is pointless to do because there's no losses to claim in an IRA anyway. But if you have funds or stocks that are outside of an IRA, this is something to consider. Let's say that you have mutual funds that are outside of an IRA and you really liked this growth fund that you are in. And you still like the growth fund, but you come to realize that maybe the growth fund itself, it has maybe 100 stocks in it, but maybe 20 of those stocks are making up a vast majority of the fund. And of those 20 stocks, maybe 5 or 6 of them are the ones that are actually outperforming. And they're fundamentally better companies. And maybe a couple of the stocks in the growth fund are, say, the Carnival Cruise or something like that you believe aren't going to come back. You can make some type of an adjustment on. So where I'm going with today is that if you have losses in your funds or in your individual stocks, you can do something that's similar in terms of going from a fund to an individual stock, and it would not be considered a wash sale. Now, if you do go from fund to fund, like I said, if you go from, let's say, SPY to the Vanguard S&P index fund that tracks the S&P 500, you're likely going to get a red flag or an audit or something along those lines, or it's going to be considered a wash sale. If you go from SPY to DIA, I think it would be a red flag. It's a gray area from everything that I've researched on it. I wouldn't mess with it. But if you go to individual stocks, you're essentially selling 30 stocks to buy 5, and that's something to consider. So that's what I would consider looking at today on with what you're doing.
Thank you for that, Uncle Mike. We still got a little time, so let's get some of you guys on the show. A little bit of your mail block.
It's time to take your seat on the All-Star Panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is indeed the portion of the program where we break down what you guys have on the brain. Before we get to that, which clearly one thing you guys all have on the brain, let's get to what we asked you. This just went live minutes before showtime, so it's fresh. So get on out there to add options, make your voices heard if you have. And we said it for the rest of the week, so you got some time. But I want to get out there, start clicking, start giving us your thoughts. I know how you leaned last week. You guys pretty heavily faded this rally. You thought we were on a dead cat bounce, thought we'd close the week shy of 2,400 in the S&P. We ended up closing it close to 2,600. So a little bit of early fade out there. So we thought, you know what, we'll give you a little bit of a longer time horizon this time, because clearly people still have the same concerns. Many issues lurking out there still to kick off this week. So we thought we're threatening 2,600 coming into this morning out there in the S&P. In fact, right now we're let's see, actually just north of it. Just take north of it, 2,601. So we're north of that 2,600 level. We said a month from now. Let's look out a month from now. So we already said we're extending the national pretty much shutdown until April 30th. So let's go out that time. What do you think we're looking at from an S&P perspective? Are we going to be north of there? So this rally may have some legs to it, may have some teeth to it. Is this, again, kind of the mother of all dead cat bounces? Going to be shy of 2,600? You think it'll be maybe hovering right around here? Not a heck of a lot net movement on the next month. We could, of course, have a lot of vol between now and then, but net on the month could be a little bit of nothing. Or, again, you guys just hanging out in cash saying, let the world go crazy. I'm good. I got my ducats under the old mattress. I'm good. So far, at least, again, this went live right before showtime, but so far, at least, you guys are still fading this, saying lower. This is the dead cat bounce with about 63% of you guys so far, followed by number 2, higher. The rally is real. So this is a higher percentage than we had last week. A lot of you guys were fading it last week. So, again, some folks out there may be feeling a little bit of this, not a lot, but more than there were. Again, early days, so this could change at any moment. 19.3% there. 12.3% say you think we're going to be right around here, right around 2,600, which is also interesting in and of itself. And only 5% of you saying, yeah, I'm in cash. I don't care. I got my mattress. I got a shotgun. I'm good to go. So let us know at Options what you guys think about this one. One thing I know is you guys have no shortage of opinions on these types of things, so let us know over there. Speaking of one thing you guys have no shortage of questions on, this is another one from Stock Picker. Like I said, we've answered this myriad time, a legion of times just in the past week, but more of you keep sending in. This one comes from Stock Picker. I have a question. With this crazy coronavirus impact the stock market, what would happen if a person owned a call or put option in the stock market closed for an extended period of time, and the option's expiration date was during this time period? Would the call or put become worthless if the stock market opened after the option expiration date had passed after 9/11? I think that the stock market was closed for 6 days. Yes, you and N96 and all the other ones who have asked this of late, Stock Picker. Again, I point you all to the unscheduled market closings guide. We've tweeted it. We put the link out there too. We mentioned it on the show. I think what I'm going to do, I'm going to grab the folks from OCC. I'm going to sit them down virtually, of course. And we're going to discuss these scenarios for you guys. So we'll have a nice, ready-to-go package. So you guys can listen to this. I can just send this to here. Listen to this. Because clearly you guys still have concerns about this. Clearly you haven't downloaded the guide. OCC, Unscheduled Market Closings Guide. It goes through all these scenarios and exactly what happens to your option. Short answer, if you have a long option, you can always exercise it even if things are closed. You can't close it out. You can't go in the market and sell it, but you can exercise it. Something to bear in mind if you're looking at things to think as they're closing. And this is being floated around out there now, maybe just shutting down the market before we even get to any of the other thing. I'm curious. I want to get you guys' pulse on this because this one is annoying me a wee bit today. We saw coming into this morning and this week, indeed, people floating out there, quote unquote experts who should know better, that we should just shut the whole thing down. Just shut it all down because that'll stop the crazy sell-offs, and let cooler, saner heads prevail. First off, I'll start with the Meatball. Mr. Meatball, if they announce this, let's say they're shutting down for a week. First off, how quickly are we limit down the second they announce that? Because everyone's stampeding for the freaking exits, of course. And then B, just the absurdity of this is just strange credulity at times. Mr. Meatball, what are your thoughts on this potential? Just shut the whole thing down, sir.
It's the stupidest idea I've ever heard.
Isn't it mind-boggling that people can float this? It's
basically because here's the problem. You shut down the markets, and the big banks and everybody that's got money can still go
Exactly. You just shut down all of Main Street's access to capital.
All you're doing is screwing over retail investors and screwing over people that have access to capital. And truthfully, what about the people that did a good job, right? So, you know what, Mark, I'm going to go off on a little diatribe here because this makes me angry. All right, so on Saturday, I had a conversation with a friend of mine, and he gave his money to an advisor who was charging him only 1% and to manage his money. Well, lo and behold, this was 5 years ago. Lo and behold, he has lost everything he made over the last 5 years. And, I'm on the phone with him, and he goes, well, my advisor said, all that's really happened is I've lost my gains. I haven't lost my investment. I go, well, then your advisor wasn't doing anything. Your advisor was absolutely worthless. If you have an advisor and you are not, if he's not doing something to explain to you how he or she has mitigated risk, what they've done different, why you're better off with them, other than, well, we've just, well, I'm really mad. Why, if your advisor, other than the fact that, well, you're matching the market now. I mean, that's not advice. That is not getting an advisory. That is crap, is what that is. So, if you are looking at your account statements and you're asking what happened, maybe ask yourself, why am I paying this advisor 1% to not do anything? And find somebody that's going to do a good job, that is going to, listen, I don't care if I'm obviously nobody wants to underperform, but I want to know what's being done with my account to differentiate it from just going up and down with the market. So, one, don't worry about the market being closed, because what you're doing, by closing the market, you're punishing smart people who manage dollars and didn't get their face ripped off, Mark Sebastian, Mike TOSAW, and rewarding jerks who all they really do are track the market and take a cut of your fee. So what I would say is, if somebody tells you, well, you're just lost your gains, you know what? You didn't lose your gains. You lost your gains plus the 1% you paid this advisor over the last 5 years to do nothing. So this is a come to Jesus moment for you, the listener, and your financial portfolio, to ask yourself, you know what? Yeah, I like this guy, but what is he actually doing? And the answer is probably nothing. Find somebody that will.
That's why our advisors option program exists, because we were terrified that people are going to ride this market up and ride it right back down again. And unfortunately, you're right. A lot of people are in that latter category right now. Their advisor, quote unquote, did nothing to stop any of this. And now they took the long stairs up, and they took a freaking plunge right back down. And that's a sad thing. Speaking of sad things, folks chiming in right now, we got this Gordon Chang listening live, saying, a friend reports that Shanghai's parks and tourist attractions are closing soon after they were reopened. China's being hit with the second wave of coronavirus infections. I hope that's just anecdotal. That's all we're hearing is from our audience here. But let's hope that's not the case. Again, I think a lot of people have a healthy skepticism of the numbers we're hearing coming out of China right now. So bear that in mind. But as we keep on rolling into our final segment, it's time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, let's go around the block. Let's see what we're all watching. I think we're all watching pretty much one thing. Hopefully what Gordon is reporting is not what's going on out there in China, but again, we don't know because you don't have reliable numbers and statistics coming out of there. It does seem a little bit dubious that they have fewer cases than us when their population is orders of magnitude larger than us, but hey, crazier things have happened, I suppose, if you want to be in the trusting state. Mr. Uncle Mike, I know you're a trusting fellow. What do you have your eye on for the rest of this week until we at least can gather here together on the program again on Thursday, sir?
I'm just wanting to see these S&P numbers to see if we can get to a double bottom level. Right now, it's not there. We've bounced off it quite a bit, but I think in the next week or so, a lot's going to happen, and that we're going to see if we get a huge rise in the death toll with the coronavirus in the United States. Obviously, hopefully we don't. I mean, we pray for that pray that it doesn't happen every day, but we're going to get a little more information on that. But also wanting to see if the S&P can hold the levels with which it is. And just right now, what the S&P is basing their numbers on are right now what's happening in the United States are like at-home businesses to where it's not a risk to the general public, and just the hope that businesses that are going to be open to the public at some point are going to thrive again, like I mentioned in the opening part of the show. So I think these next couple of weeks are very key with the numbers that we get from the coronavirus at this point in time. So watching that, Also watching to see Trump's approval ratings with his daily news conferences that he has every day to see if that continues, because this is an election year, and that's going to have a big factor on the market with how they believe and what they think is going to happen at the election time. So a lot going on, to say the least.
I forgot to ask you really quickly, you're our Perma Bull here. What's your vote on our poll, above or below 2,600 a month from now, sir?
I would like to say above. I'll say above, but it's probably the most hesitant, bullish call I've ever made on this show.
I can hear you saying you want to. I know you in your heart of hearts you want to say it. Yeah, the head sometimes doesn't agree with the heart out there. Mr. Meatball, what are you watching for the rest of this week? And also, where do you fall on our poll, sir? Above or below 2,600 1 month from now?
Well, there's a pretty big rebalance going on at the end of the quarter. 60-40 portfolios. This is kind of a known entity, but portfolios that are trying to track the 60-40 bond equity ratio need to buy stocks. So there's some belief out there that the rally out of the last few days, and certainly the back end of this rally, is some of that rebalancing. So I want to see what happens as that ends over the next day or two. We have non-farms coming up this week, which should be kind of fun. And I think that, the numbers out of China are about as believable as a Houston Astros second baseman saying that he didn't have a device attached to his body.
Indeed, sir. Well, unfortunately, that music, listeners, means we're going to have to leave it there. If you're saying you want a little more in your air holes, we got you covered. If you're listening live, we're going to pump some fun stuff in there. Going to have maybe some live pandemic huddles we just did last week, answering a lot of your questions about what's going on out there. We'll pump that in. We'll be back in a little bit. Talk all things volume, volatility, skew, all that good stuff on the crypto side. A lot popping off out there as well. So we're going to mix it up for you a little bit there. But before we go, let's go back around the horn really quickly. Let's start with Uncle Mike. Sir, Uncle Mike, if I'm upset with my advisor, they rode the market up and then they rode it right back down again. I want to mix things up. I want to change things up. Where should I go? What should I do, sir?
In the coming weeks, I'm going to be talking about having a theme, getting back to even. Contact me. This is my direct number, 630-885-0017. If you want to go to stcharleswealth.com and click a bunch of stuff to find it, that's fine. But that's my direct phone number. Call me. We'll work with something. We'll work with you on this.
There you go. If this is not your lesson, listeners, that you want an advisor who can quote-unquote do something when the stuff hits the fan, maybe you give Uncle Mike a call. See what he can do for you. And Mr. Meatball, if I want to learn what my advisor should do, or maybe what I should be doing, maybe I want to join a cool ball trading club, maybe get a sweet hat. Well, where should I go? What should I do, sir?
Yeah, no, for your self-managed stuff, come in and visit us at optionpit.com, and we'll help you learn how to not lose your shirt trading options. And, I just to throw out an endorsement for Mike TOSAW. He has my kids' money, and I just sent a couple checks in the mail to put some more money in for them. And he is somebody that I think would do an excellent job. So I am a strong endorser of him, and obviously of the Option Insider Network as a whole, but notably myself and Mark and Mike TOSAW.
Yes, unfortunately, we don't manage any money, but so you don't send us those checks. Well, you could if you want. That's more out of just pure love than anything else. But Uncle Mike is the guy to go to for that. And if you want to learn a little bit, optionpit.com is the place to go. On behalf of the Greasiest and Meatballs and Uncle Mike and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in those questions. I know you have a lot of them. We'll get to more of them as we keep coming. Go try to answer some of those directly, maybe with some more shows this week. Of course, we have OPR coming up later this week. We have the Advisor's Option. Just hit the network. If you want to hear what your advisor should be doing, then listen to that show. Just hit right now. Spoiler alert, it's a little bit of a not exactly rosy forecast for the future, but if you can handle that, the Advisor's Option is the place to go. And we'll be back in a little bit, talk some crypto, and back again later this week for OPR and all this good stuff. And we come back together here on Thursday for more of the Option Block.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.